Hello everybody. Thanks for joining us today for our fixed income webinar, which is a review of quarter one. My name's Murray Anderson, joined on the panel today, Conway, Henk and Reza. Thanks for joining me, gentlemen. Okay, to open up things, I think if we look at the world where we are today, certainly the year started off very differently. Reza, from the perspective of, I think, the Fed in particular had a particular view on interest rates and was signaling that rates would be higher for longer, and we had market participants sort of taking a different view and reacting differently. How did it play out, given what you'd seen in quarter one?
Yeah, thanks, Marie. I think, that is the pivotal question, right? And I think that if we maybe take a couple of steps back and try to ascertain how did we get to a place where asset prices were so calibrated and so indexed to the actions of central banks, and if we look at the Fed as a proximate case, how did we get to a place like that? And I think we got to take a little bit of a historical detour, and we got to think that prior to the financial crisis, you had asset prices that largely responded to the workings of the business cycle, right? So stocks and bonds, their performances was largely a function of where you were in the business cycle. You had expansions and you had recessions, contractions, all of those things, and stocks and bonds responded to the business cycle, right? So fast forward to the financial crisis, and now what you had was, for the first time, you had central banks now intervening in asset markets directly, right? So what then happens is the Fed, via large-scale asset purchases, or otherwise known as QE, they start to buy up treasuries. What it means is that diminishes the prospective return on treasuries, and the existing holders of treasuries, for example, they've got to look at other asset classes. So they've moved up the risk spectrum, and they start to buy credit. This depresses the spreads on credit, and ultimately it sort of it brings down the cost of capital for companies. But this was broadly the idea. Mm-hmm. Lower the cost of capital for companies, they'll be more prone to wanting to expand, and in so doing you boost aggregate demand. All a very long story, but essentially what the central banks were doing was that they're influencing asset prices as a means to an end for growth and consumption. The critical takeaway, what then happened as a byproduct, was that asset markets decided, as if they had a voice of their own, actually guys, we don't have to look at the real economy anymore. We can shift the lens and let's only focus on what the central banks are going to mean for us, right? Mm-hmm. So even if you think about today, if you ask any commentator or any market participant, why are they interested in the labor market? They're interested in the labor market because of what it will mean for the Fed. Why are they looking at the jobs report? Because of what it would mean for the Fed. Why are they looking at the house price? Is because of what it would mean for the Fed. So asset prices have skewed their lens of operation. They're almost like their telescope, mm-hmm, away from the real economy, and squarely it's just become indexed on what the Fed does. And just to close off, even today, so if we look maybe 20 or 30 years ago, then what was almost like good for the goose was good for the gander. What was good for the real economy was good for asset prices. Mm-hmm. But because that has changed, actually now what people are wanting to cheer on, right, is the US economy performing badly. You don't want a hot market. You don't want a strong labor market. You don't want house prices going up, simply because you know what that will mean for the Fed. So I think that was massively consequential, and as a result, there's a little bit of a history tour of how we got here, but I think that is the operative reason. In a nutshell, it was because of central bank interventions post-financial crisis that asset markets have become so indexed to what the Fed does.
Thanks, Reza. So maybe just to recap on what you've provided there, which is the market is reacting to the Fed function. And so obviously the Fed, when the chairman speaks or any of the governors speak, there's a high concentration on watching what they're saying in terms of a signal around the future direction of policy rates. And obviously the long bond yield itself. And your important point around this is no longer the economy, because typically you want to see, is there consumption happening in the market, the expansion point around corporates. Now this has choked up the market. Conway, turning to you, obviously there's been an impact on credit, and particularly with the high interest rates in the US first. This has meant that the consumer's under a little bit of pressure, but under a regime like that, I would assume corporates themselves also choke up and say, we're not going to be spending. What has that done from a credit market's point of view?
So I think just bringing it back to South Africa in particular, you would have hoped that this would have had a stimulus on the real economy, as Reza had mentioned, but actually it hasn't. we don't see a significant amount of activity in the credit market. So what you need to do is go out and look for opportunities if you need to deploy those type of capital. Right? Yes, there is a impact on the cost of capital for the businesses. Yes, we do believe that there is this downward push on spreads. But if you just think of the South African economy specifically and the global economy, there are so many headwinds as opposed to tailwinds. Risk is doing that, spreads are doing that. So what the Fed has done and the impact on the local market is it hadn't achieved what it actually had intended to do in our view. So I think when we're looking at credit, we continue to be very cautious on credit because of this downward pressure on spreads. Everyone wants the cheapest rate. There's not a lot of supply, but there's a significant amount of demand. So again, as Reza mentioned, that real economy impact hasn't actually come through in the way that had been expected.
So what we've seen is South African fund managers like yourselves looking for yield and going out on the risk spectrum and buying this credit, and as you say, forcing that premium lower and lower and lower. So opportunity. We'll come back to the credit markets locally, and maybe there's some concerns there, which I think have been well raised previously, but we'll recap on that. Reza, going back to the US long bond story now. So obviously we want to see rates being cut. There's good opportunity in the bond market if you're looking to allocate to that end of the curve. Maybe just a comment on the structure of the US market, and then if you don't mind, bring it to the local context in the South African bond market.
Yes, absolutely. Yeah. So essentially the actions of the Fed, I mean, if you think about the yield curve holistically, so essentially the actions of the Fed or monetary policy actions will largely affect the short end of the curve, right? So, so that's almost as a direct function on exactly what they will do, right? But that is not to say that the actions of the Fed don't have an influence on the long end, because remember the long end, you can think about it as an average policy component and then also almost like an inflation expectations component. So what was critical is to see that the Fed has a reaction function that is credible, simply because you want to keep the long end of the yield curve in kilter. If the market doesn't believe that the Fed is credible, right, and I'm not suggesting that that is the case, but should it be the case that the market somehow believes that the Fed is not credible, what you would then find is that consumers, market participants, their sense of inflation expectations become unanchored. Okay. And that really creates sort of havoc at the long end of the curve. Now, how we brought all this way about thinking about asset markets post the financial crisis, how have we brought that back home here in the South African context, and how have we factored this into the determinants that matter for South African bonds, taking everything that I've said into consideration? So perhaps we can have a look at our factor mosaic, which is our way of understanding the external world and bringing it back into a usable signal for South African bonds. Perhaps let's take a look at that.
Let's do that. Thank you.
So what we have here is the landing page for our South African bonds view. And what you can see is a dial which informs our suggested active duration stance. And on the left-hand side, you can see a panel of sorts which basically ranks certain factors grouped into intuitive headings such as valuations, economics, financial conditions, and sentiment. If we scroll a little bit down into what actually informs those scores and the dial itself, we come across what we refer to as our factor mosaic, which again shows all of our factors that have been proven to have relevance for the South African bond market as econometrically been tested over time. So what we have here is certain factors that relate to valuation, such as real yield, relative yield, and the term premium, certain factors which relate to economic growth, such as our Prescient in-house economic indicator and the economic surprise index, and other factors that relate to financial conditions or sentiment. Now, very importantly, and back to some of my original comments, what you will notice is that of the 12 factors, almost all of them relate to factors which are global in nature, right? So that means if you had drawn a similar factor mosaic 20 or 30 years ago for the South African economy, all of these factors would have been inward looking, and they would have been factors which are relevant to the South African economy itself. In other words, 20 or 30 years ago, prior to the advent of the financial crisis and central bank intervention, you would have seen things which relate to South African unemployment, the South African fiscal deficit, the South African current account. However, in the current mosaic, what we do see is that most of the factors are in fact global in nature. If we look at the Prescient economic indicator, that's a real-time sort of pulse taking on the US economy. If we look at the financial conditions, that's the slope of the US curve, the strength of the dollar, monetary policy in the US. We've got the US term premium in there, and we've got emerging market spreads. So we've tested over 300 variables, and what has been proven to have sort of predictive relevance for the South African bond market are the following 12 factors. And what I can say, and as basically to repeat, none of them are sort of idiosyncratically South African in nature. None of them are specifically related to South African phenomena themselves. Rather, they relate to a set of global factors which we have found to have the most relevance for the South African bond market.
Reza, thanks for that. Very insightful. I mean, what I picked up from that was that there's a lot of macro here. I mean, we did say this in our sort of review of Q4 last year, earlier on in this year when we presented on the webinar. But I mean, these global factors, the global macro story is playing out. And we'll come back to the bond positioning later. But Henk, this impacts you as well. And so probably the person in the team that manages the broadest income fund, being our multi-asset income provider, you bring all of this together in that you have the short end of the curve, you've got the back end of the curve, you've got the credit play, and you've got the international component. Maybe just some comment on what we've been discussing here, referencing rates, particularly short end, long end.
Yeah, thanks, Murray, and thanks, everyone. I think that's the sort of context and sort of the platform that's been laid has been a very good one. There's obviously a lot of uncertainty around a lot of what's going on globally, but the one thing that hasn't changed is the fact that we have exceptionally high interest rates, be it in the front end of the yield curve globally, but high interest rates. So for us as consumers, not great, but for us as investors who get to earn those yields, pretty much a Goldilocks period for people that could earn those yields, right? So be it very front end money market type portfolios, be it back end bond portfolios, be it a mix of the two, be it credit, there's a great opportunity here. Okay, so for us, when we think about income providers specifically, we need to think about one, the real return component, but most importantly, the risk component. And that's really where we bring all of these things together. So how we take what Reza said on the back end of the bond curve, our view around bonds, which is the same, versus what Conway is saying on the credit side, where we're also conservative, and bring it all together in our own risk framework. And the risk framework really is just don't lose money over 3 months. Simple as that. But obviously behind the scenes there's a lot of focus and there's a lot of detail that needs to go into that. So the opportunity for us, certainly on the bond side, we agree there's a lot of opportunity, and we'll get into our return expectations there. There's an opportunity to take some duration, but on the credit side there's also some value. You need to find them. That's why we've got Conway and team to find those opportunities within our thematic positioning. But a combination of those two components really is where we see the portfolio being positioned currently. Maybe if we can have a look at the current positioning just to showcase that and give you a sense of how we've put those all together in a pure sort of multi-asset way, to give you all a sense of where we are positioned currently. Okay, just as a start, I think to navigate and to try and make sense of everything that we've said is what we can do. Being fixed income and being mathematical, we can run an optimization. There's some simple one we're looking at here. Give it some parameters. So what I'm doing here is just saying the term to maturity of the instruments in our universe can go up to 50 years. We can give it some risk limits. So on the duration side, let's just call it 1.7. And on each instrument level, again, 50 years. And what we can do is bring in our house view. So as Reza showed us, moderately positive on bonds, negatively sort of conservative on the credit side. And we can optimize using return expectations by bringing in our views, right? So if I do this and I just run the optimization to give us a sense of where we want to be positioned, given the very broad sort of spectrum of opportunity set in the space, you can see what it does is it allows us the whole universe. So that's basically our yield curve. Gives us some opportunities that arguably too risky when it comes to duration. Some portfolios we can invest in, but probably not the best or optimal, and that gives us an optimal portfolio. And what I want to bring home here is that given what we've said, the optimal portfolio currently, given our views, given the shape of the curve, given our risk parameters, really focuses on the 3-year area in the floating rate note space. So you can see there, that's really where Conway and team comes in from a credit perspective, so where we can add some credit. That's certainly where we want to play, and that's about 70% of our portfolio. And then on the duration side, on the bond side, focusing more on the belly area of the curve. So currently picking 2-1-3 bonds, but something sort of 20-30s, 32s, etc., all giving you the sort of same sort of exposure that we are trying to achieve here. That's about 30% of the portfolio. If we then go into the actual portfolio, as I said, We look at the current positioning. Let's bring it up for us. So as of the 10th of May, the nice thing about our portal, very live, very interactive. We don't have to go on month-end fact sheets. And what you can see, what we've done here, we've got about 22% in fixed rate bonds, so that's the duration component, as said, similar to the optimization. And then a combination of different assets that sort of in that 3-year floating bucket, be it some of income plus sort of exposure in the credit space, our renewable energy infrastructure, and then sort of more conservatively positioned floating rate exposures from banks in this space. Okay, and that all leads up, if we can bring that portfolio sort of to a conclusion, you can see current sort of AUM of about 38.4 billion, a forward expected yield of 10.8, so very, very juicy as we've said, with the elevated yields, a duration component of 1.7, which we'll touch on later when we talk about that risk component, and a conservatively credit position around AA- on a fund rating using our own Prescient credit ratings.
Thanks, Henk. Good insights there. What's important about that, you showed the spread of asset inclusion in the income fund. Conway, important there as well, as we've spoken about the credit piece, but I mean, you know, yield pickup from a credit asset, it's something that's potentially listed or unlisted. There are different, you know, dynamics involved there. And that's why we have you and your team doing the research work and ensuring that we put the correct credit names in here, because what Henk's talking about is that we manage everything from a risk budget perspective. So maybe just unpack a little bit on the credit philosophy, a little bit on the process, what's included, expected yields, because I know you also manage our Income Plus fund, so maybe bring a little bit of that into your conversation as well.
So I think the starting point is that we do a lot of desktop analysis just to see where we are from a credit perspective, right? But we don't finish there, right? So the starting point is that we've spoken many times about our credit cycle indicator, which gives us an indication of where we are in the credit cycle, whether the market is very risky or not, whether it's hot or not, and the likes. So that's our starting point. It is a top-down approach using our basket of almost 220 different probabilities that we have for credit instruments. We combine the two and we get a view on whether risk is elevated or not. So very systematic in approach. The reason that we've built our credit cycle indicator is because financials are released once a year, if it's listed twice a year at best. Right? So we need to be in the market at all points in time to make a call on whether the credit market is or not is available to be invested in, or should be invested in, or we should stay away. So we built this credit cycle indicator. Currently it is elevated risk, even elevated in excess of where we were during COVID. So I think that's the starting point. But we don't end there, because yes, we want to have the best sort of a risk consideration. We have a philosophy that you need to be able to price every type of risk. So then we overlay our spreads on it, and we get to a point of whether we're being rewarded adequately for the level of risk. So I think, as I mentioned right up front, you've got risk doing this, and you've got spreads doing this. We are, just from a desktop perspective, not in the greatest position from credit. But again, if you stop there, it's very easy to say, stay away from credit, don't do credit, the market is crap, don't do anything. What we've then done is, over the last 4 years, built a credit function that can actually go out and originate opportunities. So whether Reza wants long end type credit, 10, 20, 30 year type credit, Henk needs front end, we go out and do the due diligence. We go do the consideration of risk. We do the scenario analysis. We do a full-on assessment of opportunities that are out there through our entire process, and then we bring it to our approval forums. Once we've got approval, we then can actually execute and put it into our fund based on our fair allocation approach. So I think if you just stop on desktop, you can actually see that the South African credit market is not the place to be. But we go out and originate opportunities, whether it's a 10-year Telkom deal that we've done or anything along those lines. We'll actually assess the risk, put it into a legal framework, have covenants and the likes, and then go and execute and include it in our funds, which is important. And that is why we've got a dedicated team that goes out and finds opportunities across the country.
I think that point is key, because if Henk is looking for opportunities in the portfolio, what you're saying is you can actually go and structure those.
Yes.
So with the size and the team and the capability and the relationships we have, we can go and find the pots that we want to fill with the credit names.
Yeah. And it's not only for income provider, as an example, it's for Reza. If he's completely bond bullish and he would like a entity that has a 20-year type tenor, we can go find it. We might not always find it, but we can go do that assessment of risk And importantly, because of our consideration of risk, look at various factors, including how we diversify our portfolios, what sort of allocation each portfolio should have to a specific instrument. If we have a very strong call on a specific name, we can also then show that through our portfolios. And then importantly, from a liquidity perspective, also inform how liquid certain instruments are. So for example, in the money market funds, you don't want to have a 20-year instrument, although you can't actually have it. But again, you know that you can't sell it if there are client requirements. Same thing on Reza's side. So we don't only price the risk, we price the liquidity portion as well. So that is what the team goes out and does.
Thanks, Conway. Henk, in the context of managing your portfolio and credit exposure, one of the things that I guess we've picked up in the market of late for various topical reasons has been this concept of stale pricing. So that would be a concern for clients that maybe aren't as close to the fixed income, particularly credit markets. But how do we deal with stale pricing, and what is the real benefit of an unlisted asset to an investor, and particularly yourself, in the context of this fund?
Yeah, and I think that's a great question. Conway's touched on a number of the different points, but I think what we need to distinguish first is that every asset in our portfolios is priced every day. Okay, that doesn't change. Does the price change every day is the second question. And that's where it's important to have processes in place to identify risk in that space. Okay, so a stale price is a price that hasn't moved, that should have moved. Okay, either better quality credit or worse quality credit. The topical instrument you're talking about, things deteriorated, the price was stale, people were not aware of the sort of underlying risk they were facing, and the pricing of the risk wasn't in line. Okay, Conway again touched on how surgical we get when it comes to pricing for risk. That's very important to us. So for us, we have tools and methods and screens to make sure that when we see an asset, is it priced appropriately for the asset it is. Okay, let's talk about subordinate bank as an example. Okay, we've got a curve for subordinate bank, call it tier 2, from 1 year to 5 year. If there's an asset that sits outside of that curve, one ideally want to try and buy it. Under that curve, ideally want to sell it. So that process is ongoing every day in our portfolios. So assets that's stale, that's incorrectly priced, we'll pick up, try and get rid of it. If we can't get rid of it, for whatever reason, we have a pricing forum we can go to and say, what should we do about this pricing? That's on the listed side. And then on the unlisted side, where Conway and team also does a lot of work, is we have independent pricing checks twice a year, and we revalue a portfolio that's unlisted, renewable or infrastructure as an example, once a year. So that pricing also then gets updated. Okay, so again, the question is does it price every day? Yes. How often does it change? Make sure you have a process to catch those bad apples when it does need to change, but it hasn't changed.
Sure. Okay, great. Reza, I'm going to come back to you because, again, in the context of this broader fund, the use of local government bonds is important and when required, because Henk made a reference to the current duration of the fund. Yes. But you manage the Flex Bond Fund and our other bond portfolios for not only our retail funds but institutional clients. Let's go to the long end of the curve again and maybe talk to us about the dynamic there, because I think a lot of people are concerned about the South African country risk or government risk, and maybe would saying, at this point, is it a good idea to go to the long duration assets? Some people will say, no, I don't want to be close to that. I'd rather stick at the front end because rates are higher. But I think you've got a different view on that and see opportunity. But let's unpack that.
Sure, yes. So to use Henk's descriptor, I mean, it certainly is sort of a Goldilocks environment in terms of what is on offer on a duration adjusted basis. And I mean, because of the very aggressive hiking cycle that we've seen both in the States and in South Africa, that has taken JIBAR from sort of post-COVID around 3 to where we are now to something with an 8% handle, right? And then you still get credit on top of that. So of course, now with an elevated front end, the back end almost needs to work harder to prove its attractiveness in a manner of speaking, given that you have such compelling things to contend with at the front end. So the advantage of being systematic and how we approach the sort of the assessment of long bonds is that we have a factor mosaic which effectively generates a score. And remember, to earn its place in that factor mosaic, a factor or a variable must be proven to have relevance for the bond market, right? So that's how it gets into the factor mosaic. But once we aggregate all the factors that have proven to have relevance, we get an overall score. And the benefit of and almost the proprietary nature of what we do is that we can then formally take that score and see what it means for every bond on the term structure in terms of an expected return, right? And we think that this is something of a great differentiator in terms of what we do, because of course all participants, all players, other asset managers will naturally have a view on where we are with regards to bonds. Some might like it, some might think it, we should be more bullish, some might not like it. But do they have necessarily a way to formally translate that view into an expected return for every single bond? Perhaps not, but that is certainly what we do have here. So after being able to translate that overall score for bonds into an expected return for every single bond in the term structure, we can then say, given where we are in terms of the macro landscape, given where we are in terms of the factors of relevance, what is my expected return on a 186 bond compared to a 2037 or a longer 2040 or any bond for that matter? And once we have the flavor for that, this bond view of expected returns feeds directly into Henk's process and feeds directly into Conway's process as well, when they are, for example, calculating the expected return on a credit instrument that's got a South African government bond as its companion. So the process of expected returns then flows sort of downstream throughout the business and throughout all our propositions, and that is I think very powerful. But to just bring this a little bit home, perhaps let's just look at how this comes alive on the portal. So moving from our overall score, which as I mentioned previously is moderately positive. So in other words, we are somewhat constructive on South African bonds, but not as much as had the dial been in strongly positive. What that specific score means is perhaps not that relevant to all our viewers, but we are basically here to say that we translate that score into a set of expected returns for every bond on the term structure based on how specific parts of the yield curve have typically moved in the past in response to a similar score. So we use our knowledge of the empirical history to inform what is likely to happen along similar parts of the curve in the future, in the prospective 12 months. So the current state is moderately positive, and as I alluded to, you can find expected returns all the way from the 186 all the way to the 2053, and an expected return for the index itself, seeing that we do have the constituent weights of the All-B index, right? So under the current score, you can see that the shining area of the curve is more or less the belly area, where we've got expected returns of around 14% for bonds like the 2035, the 2037, and the 2040 bond. Should, for example, the state change and we move to a strongly positive state, that in other words, if these factors above, if they somehow conspire to move the dial into strongly positive, for whichever combination that we see, it might be a change in real yields, in the term premium, in the economic growth vector, or financial conditions, but on the assumption that the score moves to strongly positive, we can then toggle our expected returns and switch on or off any part of this bar chart, which I like to call the Manhattan diagram, and we can see how the expected return profile for the term structure would look conditional on being in any of the states as shown. So this is what I've shown you for strongly positive, and it does make sense that in a strongly positive state, where the model is essentially making a case for more active duration, in that state of the world, we do have the back end of the curve now starting to outperform. As you can see, as opposed to the belly of the curve, which sort of comes out first in class under moderately positive. Under strongly positive, we see bonds from the 214, the 2044, and the 2048 appearing as top in class, which does make sense, as I said, as these are the bonds with more duration and more convexity, which stand to gain in the yield compression scenarios that typically are manifested in the strongly positive state. What we then do is we use the Manhattan diagram as an input in our portfolio construction process. This is our portfolio construction page, which essentially takes in the inputs from the Manhattan diagram, or the expected returns for every bond, and essentially shows us what the optimal way to blend that combination of bonds is, taking into account a specific risk parameter. The specific risk parameters can vary from manager to manager, or from portfolio manager to others. We've chosen downside deviation as our risk parameter of choice, because we thought that it would not make sense to penalize combinations of bonds if they had perhaps higher tracking error or volatility, seeing that those measures do not differentiate between upside and downside volatility. So we've used downside deviation, which essentially is a risk parameter that penalizes combinations of bonds every time that they are different to the ORBI on the downside. So each of these bars, each of these dots represent a different combination of bonds, taking into account the expected returns that we generated on the previous screen. So what we would ideally want are combinations of bonds that screen very well on an expected return basis, that is screening quite well on the y-axis, whilst not going too far out on the downside deviation x-axis. And these candidates, which are sort of in the upper left quadrant of the scatter diagram, are precisely the candidates that we want to look at in terms of consideration for the target portfolio. What we do then is we identify the 10 portfolios or the 10 combinations of bonds that have got the best expected return and risk characteristics as defined by downside deviation that I explained just a moment ago. Once we do that, that generates where we would like to be in terms of a target portfolio. And what we can see now in terms of where we are now, what the target portfolio wants and prefers is the base allocation to the 2037, which compromises about 50% of the portfolio, and then some minor allocations to the 209 and 2040 area, both of which screen quite highly in the previous screen in terms of expected returns, and then some allocation to the front end of the curve in the form of the 213s, the 2032s, and the 2035 bond, which both have been included very mathematically likely because of their downside protection characteristics. So as we've moved now, and as I've explained, we in a very systematic way have moved from interpreting the macro environment via a formal score. That formal score, in a very mathematical way, sets up a set of expected returns, which we feed into an optimizer in a very systematic way to give us an ideal portfolio. How the current portfolio looks relative to target, as you can see by the navy blue bars, we are very, very close. Every day we will see a to trade column, which is indicated in this column highlighted by the mouse cursor. And we have a suggested amount to trade so that we are always well in kilter of where our target allocation is meant to be.
Thanks, Reza. So a portfolio of bonds, I mean, given what you've shown there, mathematically looks very attractive from a potential yield point of view. So if somebody was going into a flex bond portfolio, what expected return could you get for the next year? Because this looks really interesting.
Yeah, so we've got a very elevated term structure. So just in terms of the raw numbers, you're looking at an expected return of around 12.5%, and that is without any yield compression. So remember, that is just on the starting initial yields of the constituent bonds that's in the fund as of today. If we do have a view that is informed by the model about what's likely to happen to yields in the form of some yield compression that could manifest itself. So if that does happen, then you're not looking at yields of around 12, then you're looking at yields of around 14%, right? With a duration of only 1 year greater than the index. So it's a very sweet deal if you are prepared to take on some volatility in the price, as these yield development manifest themselves. Right?
Okay, thanks for that. Given what you've just said, there's an implication for interest rate movements. At the moment, we know rates are high. Cost of capital, go back to that conversation, cost of capital is high. Conway, I'll bring you back in here because the cost of capital impacts businesses. We know that the credit markets, are interesting, but isn't there risk in this whole rate scenario? A cutting rate cycle would be beneficial for the companies that you look at. How do you manage that?
So I think the first thing, just go back to what Henk had said right at the beginning. It's a great place to be if you are an investor in instruments. JIBAR at 8 to 9, spread on top of it, you're earning a decent yield on credit, right? Let's start there. But the problem is with this elevated rates or higher for longer, whatever you want to call it, that means that cash flows are constrained at borrower level, which means that we need to be very careful in terms of our credit selection. Look at your ratios, look at scenario analysis, make sure that whatever you're buying from the credit perspective has enough of a moat to make sure that they can service their obligations. So it is a very tricky space to be in credit right now. You need a manager that actually knows what they're doing, isn't just sitting there and trying to pick the best. You actually need to be sitting there and going through all of the numbers, due diligence, analysis, proper systematic approach like we do run on credit. Importantly, we look at deep qualitative analysis. We overlay quantitative indicators to get to a probability of default per instrument. And as I mentioned, we rate about 220 different instruments / issuers to get that basket. Importantly, credit, you need to know what you're doing. Because again, you don't get that upside 14, 15, 16%. You simply get your coupon. So what we do in my team is we make sure downside protection is key. Then I think very importantly as a house, one of our key rules or risk management tools is diversification. And think of it like this: if you put all of your eggs in one basket, that basket gets stolen, you have no more eggs left, right? So what we try to do is we try to limit on a fund basis, depending on the mandate of the fund, what sort of percentage of fund you can have. Certain funds would, for example, only have older 2% of an instrument, or other funds could have 8, 9, 10%. But we have a strict policy: anything above 4% needs to be signed off by our committee and also CIO approval. But that diversification, we believe that's the only free lunch that you do get. Again, we do a proper calculation of what the impact of any loss on accredited instruments would have on performance. We don't want one instrument that is defaulting, and even though you might get a little bit of a recovery, to impact performance negatively. So, for example, we've done it on Income Provider, we've done it on Income Plus, which is our credit offering, we've done it on our infrastructure funds as well. For example, how long will it take us, given what the expected return is on the various funds, if there is a default, 100% PD, and then you get potentially a 60% recovery, how long will it take for you to recoup that? And sometimes we look at 12, 14 days, sometimes it's 30 days, very mathematical, but all of that is the diversification discussion where we say, don't put all of your eggs in one basket, because there will be defaults. Unfortunately, in credit, you are not buying government risk-free, and I say that in inverted commas very carefully, but you're not buying those government-type bonds. You're buying instruments that go all the way to triple B, sometimes even junk, or triple A as an example. So you have to be very careful in terms of how you approach credit. Your philosophy has to be sound, and we run a very systematic approach. I think the one thing that credit and bonds and income, everything needs to go through our rules-based, no emotion type approach, where we say, okay, cool, this is our rules that we've set up front, this is how we're going to invest. We know things are going to go wrong, but just follow the process, which we believe that we've meticulously researched across bonds, income, and credit, to make sure that we can then, again, what we're selling to our clients is a risk-based approach to investing. And that's we run through all of ours.
Thanks, Conway. So, I mean, we've spoken about credit now, we've spoken about it in the context of the Income Provider Fund, but for allocators that maybe want to get a sliver of credit in their portfolio, they can come to the Income Plus Fund that you manage. Maybe just talk about that and you know, in the context of the diversification conversation we've just had with respect to what's in that unit trust portfolio.
So everyone knows the Income Provider Fund, largest fund of its kind in the country. This is the sister fund to Income Provider. It is roughly 4.5 billion right now. We've got about 44 different instruments in the fund. We've built the fund up over the last 4 years. Nice 4-year track record. Top quartile performing fund throughout. It is the way that Reza, through his bond process, or Henk, through his income process, would actually obtain credit exposure. And again, they will treat my fund or the Income Provider or Income Plus Fund as an instrument when they're running their risk budget processes. Again, we give them an MD, we give them a yield, they'll optimize accordingly. But what it does, if there is an allocation, for example, Henk could have a 4% allocation to Income Plus via Income Provider, it is now as a basket of 44 instruments. So 5% times a 4% tells you that if any sort of single instrument does give you an issue, even assuming a 0% recovery, it doesn't impact yields on those funds. But again, what we do is we do the credit selection in Income Plus, whether it is your investment grade bonds, high yield bonds, or even a sliver of unlisted instruments. It is a BN90 sister fund, and it's also Reg 28 compliant, which allows us to take 10% unlisted instruments. And we can talk about the liquidity on those or the likes, but importantly, we have diversity across all of our instruments, even the higher yielding unlisted. And we're very proud of the track record. As I said, we don't try to aim to swing for the fences for this fund at all. We just want to be a constant top quartile performer and make sure that we grow the fund accordingly, so that the various other funds that use it as a building block or external players can get a little bit more juice when you're thinking it from a risk perspective. It doesn't ever cannibalize anything. It just works nicely together.
Yeah, got you. Diversification being important.
Yes.
Henk, maybe back to you. Also, again, looking after the cash and income. Domestic rates are high. People can get really good rates on money market. I think one of the trappings we've got is everybody's sort of choked up on leaving money in the bank on call. Probably not the best idea after tax, after inflation. You know, stepping out, we've got money market funds. Maybe you just want to talk to that. And then the alternative option that we have for investors looking for the offshore equivalent is our Income Provider Fund offshore. So maybe just bring us up to speed on those.
Yeah, sorry, thank you. And yeah, so again, Back to the theme that we've been discussing there about elevated front-end rates. Money market giving you 9.5% for the risk that money market has. So 90-day duration, 120-day term. So priced at 100, very attractive. So if you're sitting with bank or cash in the bank, I mean, you really need to start thinking about moving. It's never been a better time. You've never been paid more for just moving up into a money market portfolio that arguably in our world, given the diversification, given our understanding of market, is probably less risky than putting it in some bank fixed deposit. Okay. So very, very attractive proposition there. On the global side, very interesting, very topical. Again, to the story about high elevated yields globally. The way we think about offshore income is really finding 23 different asset classes across the income spectrum globally. For us at Prescient, we don't try and pick credit names in the offshore space, but we do think that asset allocation actually informs the largest component of your return. So if we have views on different asset classes, be it emerging market bonds, emerging market corporate bonds, EU sovereign bonds, etc., etc., if we can combine those in a smart way, in an optimal way, within a risk framework, that's the sweet spot for us. So what we do is we take the different asset classes we have, 23 of them, we'll create an efficient frontier. So for every unit of return, what is your unit of risk, and create a frontier of optimal portfolios. And then we apply the same risk framework that we do locally. So we target CPI plus 1.5, US CPI plus 1.5 on the return side, and then on the risk side, not lose money over 12 months. Okay, and then in the optimal portfolio we then eventually select is one that meets both those criteria. We go a little bit more granular, but that's a discussion for another day. And then we can form a portfolio using global asset classes in the income space, generate a very attractive dollar yield that's very diversified, very liquid. It's got all the risk management frameworks, very, as I say, diversified, and for us a very good proposition for clients. We've seen a lot of uptake, and certainly one we are pushing quite hard.
And just a dollar return that you're targeting there?
So it's US CPI plus 1.5. The current fund yield is around 6.5 in dollars, with about a duration of just under 1 year.
Yeah, thanks, Henk, for that as well. Folks, maybe to round it up, we're coming up to our allotted time. So, Reza, I think let's go back to where we started. We'll talk about global macro. I mean, yes, we hear this all the time. It's central bank driven. What is the market telling us about the first cuts? What are the expectations? I'm not asking you to make a call, but what are you seeing in the numbers?
Yes.
That'll inform us in terms of, I guess, what's going on domestically. So add some color there for us.
Sure, yes. So I can comment on what the market's expectations are as manifested in, for example, Fed futures pricing. So if we look at that at the end of last year, there were 3 or 4 cuts that had been priced in to occur over the course of 2024. Those sort of realizations or those expectations had to be scaled back iteratively. As new data came, was printed with regards to the labor market or job creation or consumption or inflation itself, right? So at the moment, as it stands now, there's only one cut being priced in for the remainder of 2024 to occur at some point in the latter part of this year. That is by the Fed, and to a large extent, in order to, this is not the complete set of considerations, but to a large extent to preserve real interest rate differentials, it's very, very likely that global central banks would largely take their cue from the Fed. It's not the statistical rule in stone, but it is certainly something that they are conscious of. So if we look at the equivalent, sort of pricing, and Henk will very likely make some comments about this, then we're only looking at sometime next year to in fact see, cuts, within the South African context. So what that really means, and to bring that back to our initial sort of entry point, is that sort of the longer the US economy remains robust, and the longer the US households balance sheet remains sort of intact, and as long as consumption proceeds at a healthy tick, that is almost cross-subsidizing this idea of the Table Mountain profile of higher for longer in terms of policy rates, right? And what that in turn means is that has a direct bearing on the movement of global capital. To put it simply, a big theme after the financial crisis was this idea of a carry trade. So the carry trade was borrowing at zero, because that's where policy rates were after the financial crisis, borrowing at zero, plowing it into an emerging market high carry destination and pocketing the difference, right? That was the classic carry trade. And we've almost seen the death of the carry trade, given that you can't borrow at zero anymore, right? So it's just so much of a hurdle, so much of an opportunity cost to forego, given that you are essentially earning, we've heard the number earlier on, 5 or 6% in USD terms for a low duration offering. So a global US-based investor will need to think twice, is it worth it putting my neck out for emerging market duration risk when I can get 5 or 6% in dollar terms from the US front end? And that has really been the dynamic that has informed the performance of the South African bond market. Now, for me to now say it, no, it will all come to a crashing end and the party will start again and then start drinking the punch again at the end of this year, I don't have a date for you, but what I can say is that we need this dynamic to unwind, right? You know, it's very good in terms of what one can secure in terms of income-based products or short duration products, but in terms of bringing it back to the performance of risk assets more generally, we need policy rates to essentially go lower in the developed market economies and for that risk capital to start wanting to look for other homes again, the South African bond market being a beneficiary of that, right? One other thing that I'd like to just mention in terms of the various premia that are sort of embedded in the South African yield curve at the moment. I mean, there's a lot of noise and there are a lot of conversations that usually happen at around this time around things like a national election, and we're not in any way trying to downplay the risks or the significance thereof, right? What we simply are saying from a systematic perspective is that if you think of elections happening every 5 years, let's just say, or 4 or 5 years, depending on the locality, but if you then looked in a 20-year history from a purely data perspective, right, looking across a 20-year history, elections happening only every 5 years only, you basically have only 4 or 5 data points, right, to now start to make an inference between what's likely to happen between an election outcome and the asset markets, right? And generally one finds only spurious kind of relationships between election outcomes and what happens in the asset market. So we're really not in the game of trying to do that. We just think that the data is simply too thin to make such a prognosis, as it were. What we can, however, say is look at the risk premia themselves and see what is actually being embedded in there. And we needed to find a very, very clean and mathematical way to see what exactly is the default risk that has been priced in South African government bonds. I mean, it's a very interesting thing to, and one of the factors in our mosaic relates to something called the term premium. And the term premium is essentially the compensation for exactly that risk. Why should you have a term premium in a bond investment? Well, because the risk is that you're not going to get your capital back. That's the only reason someone would invest in a 10-year bond in lock-up fashion, as opposed to rolling a series of smaller, shorter dated bonds 10 times over. So what we do find, if we examine that, is that there has indeed been a step change in the term premium. In other words, you are getting compensated for the fact that precisely the fact that default has been priced in. But that has not happened now. That happened in the eye of COVID. So phrased in a different way, South African bonds have already been priced for default since the onset of COVID. That has already happened, right? And all that has happened is that great amount of premium that was already embedded has just gotten higher. So as to answer the question now, some people are asking us, the media, has the prospect of the elections raised the risk of South African bonds in default? And our answer is no. There's been no step change in these 1 or 2 months prior to the election. We think that the pricing of the default has already happened, and that occurred in 2020 already. So not trying to hypothesize which direction the election is going to go. That's not our game here at Prescient. But what we can say is I can comment on the risk premium that is already embedded in the bond, and I can already say that South African bonds are effectively priced already for default.
Yeah, thanks, Reza. Appreciate that insight. Henk, in closing, maybe some last comments from yourself, and then we'll go to Conway.
Yeah, I think just maybe the one sort of area we haven't touched on is market expectations for rates in South Africa, very, very front-end focused. Very similar to what Reza has explained, so more expectation for cuts as we came into the year. That's been sort of tapered back somewhat. Most recently, about one interest rate cut price sort of through the forecast period, so not a lot of relief. But yeah, we'll see what happens on the Fed side. As Reza said, the expectation rates to start lowering, and the impulse usually from central banks globally is to sort of follow suit. But yeah, on the front end, higher for longer, earning rates, great opportunity, and as it stands, we'll keep taking it.
So I think obviously just the two things that we consider internally. One is credit the right place to be invested in right now? And as Henk mentioned again, great yields that you can get on credit right now, comparing it to what you get from equity markets at low volatility. But the important part is, if that comes through what Reza had mentioned, later on in the year or next year, where we're going to have a lower sort of interest rate environment, it will be better for interest servicing, and something that we'll watch out for very carefully, because that obviously impacts PDs. So again, you have to just always balance the two. Great for investors versus great for borrowers.
Great. Thanks, gentlemen. I think that comes to the end of our webinar on the fixed income side today. Folks, maybe I can just ask you to look out for our Prescient On Point, which is a new quarterly publication that we put out recently, well, this week. Obviously, it'll come out quarterly going forward. That's Prescient On Point. In that, our investment team will be talking about their funds and their particular asset classes or segments of the asset class. So we encourage you to have a look in there. We'll also have updates on our funds. And just as a reminder from this team, we're talking about money market, corporate money market, yield quants plus, income provider, income plus, flex bonds, and of course on the global front, our global income provider fund. Thanks very much, folks. We'll take some questions now. And again, thanks for joining us.
Hi, thanks very much for joining us on that interest-bearing webinar. It's always a pleasure for us to be able to share some of the process insights and some of our thinking with you. In terms of the questions, we've got some questions coming through, and I see that there's one that falls a little bit into my court. So we've got a question coming through asking that the SARB has recently signaled that it would like its inflation target to change to 3%. Seeing that the SARB utilizes interest rates to target inflation, is this not a massive risk, as it would result in a structural change in the bond market, right? So how do our models account for this, and what do we think about that question? Yeah, so a popular question, quite interesting. So maybe a little bit of, in typical bond fashion, a little bit of a historical detour. So the SARB initially, started with defining the inflation band that it targeted between 3 and 6%. So if inflation sort of ended up at 5.9995, that was job well done. And then at the time around 2017, when the SARB initiated the quarterly projection model, the model needed a point estimate for inflation targeting, and that point estimate was taken to be 4.5%, right? So now, the SARB was now almost explicitly saying that its new target would be 4.5%, as opposed to just getting it a fraction under 6%. The interesting thing, and why I mentioned this, the relevance of that, is because the SARB was then able to successfully guide inflation expectations towards 4.5% without a very punitive hiking cycle. And I think that is very, very important. And I think that, and this is the point that we always make about the credibility of a reserve bank. So if a reserve bank is credible, if the market generally is trusting of the reaction function, then they are able to guide inflation expectations as to wherever they should sort of specify the point. So if that becomes 3%, certainly our contention that the SARB does have credibility, and that it may very well be possible to get inflation anchored towards a lower figure without a very, very punitive hiking cycle once more. So what that will do, and I agree that it is a structural change for the bond market, is that, if you think about long-term yields, so let's, for example, discount the noise that is often embedded in the short-term yields on account of it being captive to monetary policy. If you think about long-term yields, you effectively are sitting with a real interest rate component, an inflation expectations component, and an inflation risk premium. So what will then happen, if the market does start believing that the SARB can credibly get inflation to 3%, is that inflation expectations channel, or that component of long-term yields will compress, and we could, all other things being equal, be sat with sort of lower long-term interest rates, which is certainly a good development, right? So and just the second part of that question, how do we formally account for this? You may remember that in our factor mosaic, we look at real yields, we look at relative yields. So this will feed directly, into how we compete those, how we sort of compute those scores. Rather, if we have nominal yields at a particular level with lower inflation expectations, then we have higher real yields. and all other things being equal, that argues for adding more duration. So we have thought about it. It does feature in the models, and we do think it can be a structural change, but I think it's a change in the right direction.
Cool. Excellent. Thanks, Reza. I think there's another one that's probably closer to my sort of ambit, or at least my sphere. The question is, what's the difference between investing in the actively managed ETF that we've launched and investing in the unit trust? So that's a great question. And the answer is that's exactly the same. So the ETF listed on the JSE is a feeder fund, so it invests straight into the unit trust, so there's no difference in your exposure. We did it this way so that clients have the option to either go into the UT or buy it via the JSE, which is the ETF version. And yeah, we've seen great growth in the ETF. Certainly something we're excited about, and an avenue for investors and clients to access the fund via something that's a little bit more public.
I think there's just one last question. I see it's for credit. What is the importance of monitoring borrowers? I think the simple answer is this is where you make money or you lose money. If you need to consider how you actually get to a default probability, it is through considering financial statements, considering what management presents to you, and then doing scenario analysis and the likes on it. You always want to be able to have a forward-looking view on default probabilities. You want to be able to make an assessment knowing that your cash or your obligations will be met. So with that in mind, we've got a team that considers all of this, and especially and very importantly, it takes a forward-looking view on default probabilities. So monitoring, again, very important. You can't just do desktop analysis. You have to have the discussions. You have to take all of the factors into account, including the financials, but also the macro, to make sure that the investments that we do execute on actually deliver on the promises that's been made.
Yeah, that's it. I think time's up. Thanks for everyone for listening. We know it's quite a long session. We appreciate your time and look forward to sharing more with you in the future. Thank you.